Hey everybody, so this is going to be part 3 of my information gathering series, and in this video I'm going to talk about my favorite website. It's called investing.com. Now this website has just a wealth of information, and I strongly recommend that when you use this website, you use it with Brave browser because this website does tend to have a lot of ads. So let me just show you why this website is so amazing. So I'm just going to show you a quick feature right here. It is under the markets tab. You go into indices and indices futures. So right here, it gives you some insight on what's going on in the futures market. So over here in the futures market, a lot of people, they're constantly trading contracts. And I like to pay attention to this when the actual markets are closed. So, after the markets close at 4 p.m. Eastern Standard Time, I jump over here, see what's going on in the futures market, and it does give me some sort of idea on what the directional bias could be for the next day. So that's one of the reasons why I do enjoy it. Now, let me just talk through these different line items right here. So US 30, that is the Dow Jones. US 500, that's the S&P 500. US Tech 100, that is the NASDAQ. Small caps 2000, that's the Russell. S&P 500 VIX, that is the VIX. So now let's go over and let's take a look at this right here, commodities, real-time commodities. Now I love looking at this one as well. So right now, obviously, the markets are closed because it happens to be Christmas. I'm not really sure why I'm making a video on Christmas. But anywho, let's just go ahead and talk about this. So this just gives you a list of commodities. It shows you the price change. So when you see something like palladium and platinum up over 4%, that might pique your interest. Like, hey, what's going on in the commodities section and why are these two metals up so high? So that definitely may pique your interest. And, I do like to pay attention to crude oil, WTI, and Brent. Because, obviously, if these are constantly going up, that's not necessarily a good thing for inflation. Now, let's go ahead and look at the bonds. So bonds, I like to click on bonds, world government bonds. And I like to filter just for the United States. And I like to look at the 2 years to 30 years. So if I'm just looking right here, I see the 2-year notes, I see the 20-year bonds, 30-year bonds right there. So we can kind of get a snapshot of what the yields are and what the yields are actually doing. So if I'm correct, I believe that the Fed funds rate right now, the target is about 4.25 to 4.5. So, it's very important to pay attention to these yields because obviously if these yields are going up, that means interest rates across the board are going up as well. Now, let's say you're a dividend investor and you really like a dividend stock, but the yield is only 3%. Now, does it make sense to buy that stock just for the dividend? Not necessarily, because over here you have two-year notes giving you 4.327%, and this is pretty much risk-free. They call it risk-free interest because the United States, they're probably not going to default on their debt. So I do like looking at this bond feature right here. Now let me tell you about my favorite features, which is the news and the economic calendar. So starting with the news sector, it gives us all these different tabs right here. So we could look at the latest news, the most popular. We could look at crypto, specific news, stock market news, or we could go into economic indicators, economy, forex, commodities. So if I click into commodities right here, we can see it says Mexico's newest oil refinery now seen working at half capacity in mid-2023. Or storms cut United States oil, gas, power outputs, sending prices higher. So we could see all of these Reuters reports. Now, right here, I could do economic indicators. It says right here, United States consumer spending, inflation rise moderately amid rate hikes. U.S. consumers' 1-year inflation outlook drops to 18-month lows. So you see all this wealth of information right here. Now, what I really, really like, my favorite part is this economic calendars right here. So I'm going to show you what makes this amazing. So we're going to go over it. We're going to filter. Now I could look at economic calendars by country, but I just want to focus on the United States. Now I could also pick my time horizon right here. I want to do, let's just say everything from the 31st to, let's just say, January 20th. All right, so here we can see, oh, hey, we have a holiday. It's on January 2nd, New Year's Day. So the stock market is going to be closed. So definitely don't do any YOLO weekly calls or whatever. You're going to get burned by theta. And right here, it shows the importance. So 3 stars is very important. 1 star is not too important. It shows the time. So the time is going by Eastern Standard Time. And it actually shows forecasts as well as actual numbers and previous numbers. So let's just scroll down a little bit. Let's kind of look at some of the stuff. Let's take a look at Jolts. So Jolts has a 3 star. So let's click into this, see what's going on here. So it gives us this little summary of why it's important. It says a survey done by the United States Bureau of Labor Statistics, so the BLS, these are the same people that give us the inflation report, to help measure job vacancies. So it collects data from employers about their business's employment, job openings, recruitment, hires, and separations. So it says JOLTS defines job openings as all positions that are open, not filled, on the last business day of the month. So we usually get this information right at the beginning of the new month. So right here, we could see all of these job openings, and we could see, this number has been declining a little bit, as you guys can see. So right here in February of 2022, this was right around 11 million, but all the way here in November 30th of 2022, this is down to 10.3 million. So here we can kind of see things are slowing down a little bit. Now we could scroll down, we could continue, we could look at average hourly earnings. So average hourly earnings, this number, it's going up, it's going down. So right here, we can see that it was pretty high. So right around, let's see, for February, that was reported in March of 2022. This was around 5.1%. It went up to 5.6% in April. That was reported for March. But we can see now it's right back down to 5.1%. Now we're actually forecasting that it was going to be pretty low. So it came in a little bit higher than forecasted. Now we could look at non-farm payroll data. So it says right here, non-farm payroll measures the change in the number of people employed during the previous month. Excluding the farming industry, job creation is the foremost indicator of consumer spending, which accounts for the majority of economic activity. So if you're not too familiar with GDP, consumer spending makes up the biggest portion of GDP. And right here it says a higher than expected reading should be taken as positive/bullish for the United States dollar, while a lower than expected reading should be taken as negative/bearish for the United States dollar. So let's just scroll down. Let's take a look at this. So non-farm payrolls, we were expecting 200,000, but we got 263,000. So it's a little bit higher than expected. So this information is kind of showing, hey, you know what? The job market is still a little bit more resilient than we actually think that it is. So let's just go down here a little bit more. We see unemployment rates. So let's just read the little excerpt. The unemployment rate measures the percentage of the total workforce that is unemployed and actively seeking employment during the previous month. A higher than expected reading should be taken as negative/bearish for the United States dollar, while a lower than expected reading should be taken as positive/bullish for the United States dollar. So right here, we got 3.7% in the most recent reading that was on December 2nd for November. So this information, it's obviously lagging a little bit. So they call this a lagging indicator. Now the Fed, they want this to be around 4.5% for 2023, I believe. So they definitely do want to see more unemployment. Now, I personally think that things are going to get a lot worse than 4.5%. It could go up to 5%, which is what a lot of people are saying. So, this number, we could see this go up in the coming months, which is a little bit unfortunate. Now, let's just go down a little bit, see what other kind of information we can see. All right, so this is the big one. Thursday, January 12th. Write this one on your calendars. We get core CPI and we get headline CPI. And we get this in year over year and month over month. So let's just take a look at the month over month for the core. So once we actually get closer to the reporting date, we're going to see a forecasted number. So right now we're not necessarily there yet. We have to be a little bit closer to this reporting date. So if we're just looking right here, the last report came in a little bit under forecast. And even the previous report before that came underneath forecast. So we were expecting 0.5 here in November for October, but we got 0.3. Now notice here again, it's reporting for the previous month. So this is a lagging indicator. Now people, they're always saying, hey, you know what, the Fed, they're so reliant on these lagging indicators. They don't even see what's in front of them. So this is what they're talking about, lagging, leading indicators, all of that stuff. So what is inflation going to do for January, for the month of December? I have no idea. We'll figure that out when we get there. So, this is basically a gist of investing.com and why it's so amazing. And I hope you guys enjoyed this video.